Sure, let's welcome in Gautam Duggad, Head of Research, Institutional Equities at Motilal Oswal Financial Services. Gautam, good morning. Great to have you with us here on CNBC. Thank you for your time. So, numbers is what we want to get a sense from you, Gautam. Small cap valuations now relative to Nifty valuations, relative to historically, where do they trade at? And same thing for the mid cap index as well. Give us a sense as of now.
Hi, Prashant. Good morning. Thanks for having me. So, as far as valuations are concerned, Prashant, both mid caps and small caps are still at a premium to large cap as well as their own historical averages. The only index which is now below long period average is Nifty 50. It is now about 19 times, which is 7% below its long period average. For small cap, it is trading close to 22 times. Usually it trades at about, if you look at the average, about 17 times. So long way to go because usual 10-year discount for small cap index is close to 24%. Right now it's at a 15% premium. As far as mid cap index is concerned, usually it trades at 5% premium to long period Nifty average. Today, after this 20% correction, it is still at 28 to 28.5 times, which is still about 50% premium to Nifty. So clearly, valuations are still very elevated in mid and small cap space. The other problem, Prashant, is that in the recently concluded earnings season, you've seen a big decline in small cap earnings. So for our coverage universe of about 121 small cap stocks, while we were expecting a 5% earnings decline, we got 24% earnings decline. And for a 9-month basis also, the earnings are down 18% for small caps. Plus, the broader market revision is very bad. If you look at the earnings downgrades, we've done about 137 companies where earnings have been cut by more than 3%, and there are only 35 companies where earnings have been raised. So, whichever way you look at it, valuations, the recent earnings performance, the forward earnings revision, it's all a bit weak for small cap. Mid caps are a wee bit better. We've seen a close to 20% plus earnings growth for mid cap for the quarter, obviously. On a 9-month basis, the mid cap earnings are also up just about 8%. So earnings is where the problem has emerged in this year, which we've been discussing in the past shows as well.
Gautam, just to complete the valuation point, lots of numbers there. But mid-cap index, you're saying on a long period average, trades at a 5% premium to Nifty. Right now, it's at a 50% premium still, right?
Yeah.
And same number for the small cap index as well? Long period
Yes,
relative to Nifty and where it is now?
So long period relative to Nifty is close to 20% discount. Usually Nifty trades around 20 times if you look at a long period average, and small cap between 16.5 to 17 times. Today, Nifty is at 19 times now, and small cap is still at about 22 times.
Okay, so yeah, I mean that valuation comfort that everybody is in search of after this correction, maybe it's not entirely come through. Gautam, hi, morning. I remember, and why just small cap and mid cap? In your note, I remember you saying that even the Nifty, you are circumspect about FY26 projections of 15% Nifty EPS growth as well, right? So your preference is large caps. One understands that. So what is the approach? What can you buy in this market fall? Because the problem with buying large caps is that it's like starting, 100 meters before the start line. Because when you buy large caps, you first have to deal with the FPI selling. That's just not stopping. So whether if you buy an HDFC bank or whatever large cap you buy, because of that excessive selling, anyway, there's pressure. And that pressure is not going away. So what's the approach now?
So Surbhi, flows are not in your control or anybody's control, right? And it's not as if that FIs have started selling recently. In fact, things have got exacerbated in the last 3-4 months, obviously. We've seen close to $28-29 billion of selling. But look at it this way, they've been selling for some time now. If you add up the flows of FIs from CY22 beginning to now, it's a negative $10 billion number. So that's been an outflow of about $10 billion on a 38-month basis, right? What is in your control is to look at earnings versus valuation equation and then see where the relative comfort on risk reward is. That clearly today is lacking in mid and small caps, though it has become a little bit better given the recent correction that we have seen post-November. In large caps, you've seen that at about 19 times, your expectations are not too elevated. When we are talking about an embedded earnings expectation of 15% growth for FY26, we still expect that earnings to go down a little bit more in the next 3-4 months. We think that for Nifty, at least the earnings will be in double digits, can be 10-12%. The problem is in the broader market earnings expectations. The broader market earnings expectations is still about 20% growth, which looks a bit stretched to me right now. Maybe we'll settle at about 13-14% growth there, if you do the various sectoral calculations. But that basically means that you're still up for 5-6% more earnings downgrade there. And news flow around small mid-cap earnings cut can continue to create overhang for the valuations too. In large cap, there are sectors where both on an absolute and relative basis, now the valuations are looking quite attractive. Obvious name is obviously large cap financials, where you preempted it, and hence you asked about FPI selling, because whenever FPI selling happens, given that they own large part of the banks, they will definitely see selling in banks. But that's been the case for 6 months now, and in the last 6 months, despite the FI selling, the large cap banks have sort of outperformed the market in the correction, right? And you've seen earnings broadly was quite okay in financials, especially for large cap PSU banks and large cap private banks. Second is pharmaceuticals, which has posted 7th consecutive quarter of 15% plus earnings growth. Then you have IT, which is obviously benefiting from both currency depreciation as well as some uptick in US BFSI discretionary spending. And then you have to go bottoms up even in large caps, because when we say large cap valuations are attractive, it doesn't mean all the 100 top, because that's the SEBI classification for large caps. It's not as if 100 out of 100 large caps valuations are attractive. So you obviously have to, get your head down and do more bottoms up work even there.
All right. Hi, Gautam. Good morning. Good to see you. And Gautam, but some of those companies from the Nifty pack itself, they've seen a PE, devaluation to quite a large extent, right? By 15, 20, 25% as well. You want to name some of those stocks? Just in the last 6 months or so, some of them have seen a sharp contraction in their PE multiples as well. So which ones, are looking fairly okay right now?
So, Nigel, we just put out a note a week back about the relative de-rating and re-rating within the Nifty 50 constituents between September and now. And we've looked at it in the context of earnings changes also, which have happened in that 6 months intervening period. You've seen, surprisingly, stocks which were supposedly trading at lower P have got derated the most. Some of the commodity names, some of the utility names, some of the auto names, they've got derated. Obviously, the high P names have got derated too. But you would have expected that in a falling trend, some of the utilities which are supposed to earn regulated returns on equity and which had not seen massive re-rating in the up move, I have also seen commensurate de-rating while the markets was correcting. Insofar as the broader de-rating is concerned, Nigel, without nitpicking, I would say broadly all sectors, barring banks and to an extent IT, have got de-rated in the last 6 months. Banks have not de-rated because they're hardly re-rated. In fact, in the period between FY19 to 24, when the banking sector profitability went up 9x from the bottom, and I'm talking about our coverage universe, the Motilal Oswal private plus PSU banking coverage, where the profit went up from close to 35,000 crores to 3 lakh crores between FY19 to 14, which works to a compounding of close to 55%. The valuations have got derated in that 5-year period by 40-50%, when the earnings growth was the strongest and when markets were doing well. So now when the markets are coming off and the rest of the sectors are seeing some correction in their valuations, banks are broadly, are holding up as far as valuations are concerned now in the last 4-5 months.
Okay, let's that's a solid stuff on valuations, earnings, etc. Gautam, now let's just talk about a few sectors. Pharma, right? Recently, in the news for the wrong reasons, President Trump is saying 25% tariffs on pharma imports. Now, the consensus is that it's unlikely on Indian generics because they're hugely dependent on them. Already razor-thin margins on generics, and it raises the risk of drug shortages, etc. There, if this is done, as companies will reorganize portfolios. What's your sense, and what's the advice to investors? And is this a worry that you're hearing?
So, Prashant, we are living in an uncertain time right now for virtually every sector. There's going to be a massive news flow globally, right? Because there are a lot of policies which are getting unsettled. So, therefore, there is going to be massive volatility in the stock prices. Now, it is a good as well as a bad news, depending on what is your investing horizon. As far as pharma is concerned, we echo the same view that it's not going to impact Indian pharmaceutical companies by a wide margin. But what can happen, Prashant, in such scenarios is that while earnings impact might be very limited or negligible, the P's can come off a little bit, given the uncertainty and overhang which got created by some of these announcements. So if your horizon is more than a year or 3 years, definitely this is an opportunity to buy into some of those names. As I mentioned in the beginning, pharmaceutical is the only sector right now which has for last 7-8 consecutive quarters posted more than 59. In fact, 20% plus earnings growth consecutively. And the spread of the earnings has been good. There's not been much downgrades on pharma. So we'll look to selectively, add allocations in pharma on any downside which comes about because of these announcements.
Very quickly, Gautam, just two stocks from your list of preferred stocks that you like, and they're really interesting. I'm picking them out. One is Trent. There's so much price damage that the stock has gone through. Just tell us why you still like this story. And the other is Dixon. I picked out these two because both were trading at elevated valuations, right? And even with Dixon, the whole issue was that, is it not already all in the price? Is the company operating at 4-5% margin? How much are you going to keep paying for it? Why is it that you still like these two, despite that whole valuation argument and the stock price correction?
So, Surabhi, the reason we like both the stocks, that reason has not changed, which is the growth leadership in their respective categories. Trend is still printing 30 to 40% top line growth, whereas the sectoral peers are finding it difficult to even grow at 10 to 12%. So the execution excellence is well demonstrated as far as Trend is concerned. And they've been also able to clock a much superior earnings growth and margins. From the price where we upgraded the stock at 1,200 rupees about 3 years back, clearly the valuations have gone to a very different level now. Not that it was cheap to begin with. Even at 1,200, if you had looked at the P in April 2022, the Ps were quite elevated. Because the growth...
8,000 then. Then it went to 8,000. And now it's up 5,000. It's been, really a roller coaster, right?
Yeah, but look at the underlying earnings also, because that is what is the critical driver of stocks like Trent or Dixon, or for that matter, some of the other, more expensive names. So given that markets are down 13-14%, and you've seen some, bigger price damage on some of these highly priced names, I think if your growth horizon or growth visibility has not changed, and if your investing horizon remains more than 2-3 years, then these are still very attractive opportunities, I would think, especially names that you mentioned and singled out. For example, for Dixon, it's the only company which is still generating cash flow while growing at a much higher pace in that sector. Kane leadership, top line has clearly created a very different scale without compromising on the margins and cash flows. This kind of opportunities will keep coming. Obviously, you cannot time the bottom just like you couldn't time the top. But if your underlying thesis on the growth leadership of the company sustains, I think sooner or later you will start compounding in line with the underlying earnings growth.
All right, Gautam, thanks a lot for joining in, pointing out all those factors with regard to earnings growth, valuations that we are at as well. I don't know, the optimistic me is just hoping that maybe with all the recent measures from the RBI, the capex push on ground as well, could Q4 in some way surprise positively. Let's see how that goes. But for the time being, Gautam is saying that maybe the street is actually overestimating the earnings growth for the Nifty, which could get pulled back a little bit for FY26, and more so with regard to the broader markets as well.